You're about to join Niels Larson on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Rob Carver and I, Niels Larson, where each week we take the pulse of the global market through the lens of a rules-based investor. Rob, great to be back with you this week. So much continues to happen in between our conversations. How are you doing today?
Yeah, well, obviously it's Friday, which is good. And as we were discussing before we came on air, I'm going to be taking some holiday soon, so that's equally good. So yeah, all good.
Lots of things to look forward to. Just like today, I hope people are looking forward to the lineup we have in terms of topics and questions that we'll be tackling in today's episode. But before we do that, let's do as we normally do and just kind of hear what's been on your radar, what you've been focusing on since we last spoke a few weeks ago.
Yeah, I mean, in terms of performance, actually, it's been pretty good. So I'm still in this kind of gradual, slow crawl out of the horrors of March. Which, although to be fair, I wasn't hit too badly in March compared to a lot of people. So I think in March I lost like something like 4.5% or something like that. And given that I run a reasonably high vol target, that's actually quite good. And then things are going to flatline for a while. And actually, the last few weeks has been pretty positive. So that's quite good. I actually recently made some changes to my system, introduced a whole bunch of new markets. So I've actually got data for over 200 futures markets. I'm not trading all of them because some of them are duplicates. So, for example, I collect data for both the micro and the mini S&P as an example. But obviously, there's no point in trading both of those. And quite a few of the markets I sort of have in my system, but I don't actually take positions on them because they're a bit expensive or not liquid enough. But yeah, a slug of new markets in there. Just looking at my current risk levels then, sort of slightly higher than the risk has been quite low the last few months, at least in terms of expected risk rather than realised. So it's a little bit higher than it has been, although still below average. And my biggest risk actually is in the volatility sector, which is remarkable in a sense because actually that consists of just three instruments. So it's not a big sector in terms of numbers of instruments. And just looking at my exposure, so I'm short vol, which is like a risk on bet effectively. I'm also long equities, which again is another risk on bet. And I'm also, interestingly, given it still continues to be a very topical subject, I don't actually have any exposure at the moment in interest rates or bonds at all. So that's I'm kind of sitting on the fence in terms of the big kind of debate between inflation and have we peaked and debt ceiling and all of this stuff. So that's kind of interesting as well. My biggest long position is in Chinese US dollar FX. I've also got a longish position in live cattle. Looking at my shorts, I'm short yen dollar, I'm short lean hogs, I'm short VIX as I've already discussed, and I'm short Euro VIX V stocks as well, if you like. So yeah, it's an interesting period. So very quickly, if I may, one thing I do every year in April, because the UK tax year runs to April, so I have to, look at my performance for tax purposes. So I kind of do a bit of more extensive look at my performance generally and put something on my blog as well. So this time period probably doesn't mean much to many people, and most people don't focus on it because obviously we normally focus on things like calendar years. But just out of curiosity, so kind of interesting findings. One was that the 12 months to April, so wasn't a great period for me actually. I was down, and obviously the horrors of March kind of contributed to that. But I was down about sort of 9%, which is, I think my second biggest loss since I started trading my own money about 10 years ago. But a 9% calendar year loss as a bad loss, I think for equity traders would be quite a good outcome. But so one thing to kind of noticing is that actually not much did well last year in terms of different trading rules. About I think a couple of things, a relative carry did well, Outright carry didn't do well, and mean reversion, I've got a kind of long, slow mean reversion signal that did well, but everything else, carry, momentum, did badly. So that's why it was kind of a relatively poor year for me. Other things that are kind of interesting that we don't talk about, so we always talk about performance, which means net performance, right? It means performance after costs, but we don't really talk about costs. So I thought it'd be useful to kind of give you a flavour of what I actually pay in costs. Looking at the year to April, in terms of commissions, I paid 21 basis points, and in terms of slippage, so the difference in the mid-price and where I execute, I paid about just under 70 basis points. So my total costs were 90 basis points, which is less than 1%. So that just gives you a flavour for that it should be quite a cheap strategy to trade, sort of medium speed trend following. It shouldn't be sort of super expensive.
And is it normal for you to have more cost on the slippage side than the actual commission? Is that completely normal, that ratio kind of 3-to-1?
Yeah, that is normal, and I think it'll depend a lot on the sort of amount of capital you're trading. So if you're because commissions are, for retail traders, commissions are kind of fairly fixed. I mean, you can pay a lot more, but I've got a fairly competitive commission. But if I was trading, say a quarter of the size I'm trading now, my commissions would be probably a little bit higher in terms of that equation. If I was an institutional manager, I'd expect my commissions to be almost zero, pretty much, as a proportion of my capital. But slippage would be a lot bigger. It'd be a lot bigger proportion. So that's a good way of thinking about it. But the sort of 90 basis points, 1%, 1.5%. I'd be surprised if there were many people out there trading at a similar speed to me who weren't seeing similar kind of numbers to that. I think I'm maybe slightly lower than average because I've got this fancy dynamic optimization, and one thing it does is deliberately reduce costs, but my costs are actually lower than they were, say, 3 or 4 years ago when I was trading a more kind of vanilla system, if you like. But yeah, most people should be in that ballpark.
Yeah, I mean, slippage is not something we talk a lot about, frankly, but of course, for some strategies, it's quite important. I agree, for long-term trend following strategies, even slippage is not a big thing. Although, I guess it really also depends on how people calculate slippage in that sense. I guess if you're using a sort of a stop in your approach, it would be the theoretical stop price that you want to trade at, and then compared to the actual price you traded at. You mentioned something about a mid price, but I guess that's because you're using a continuous signal, and so I wasn't entirely sure what you meant by the mid price, frankly.
Yeah. So it might be worth going into a little bit more detail. So when I backtest my system, I'm using daily closing prices. Now, it's actually impossible for me to trade at the daily close. So there's people have different approaches to that. What I do in my backtest is very simple. I assume I trade at the following day's close. So I assume a 1-day lag in my system. And actually, this is a really good test to see how sensitive your system is going to be to execution delays, because you can compare your system with and without this 1-day lag. And if you find a massive difference in performance, it's quite likely you're trading quite quickly. And using daily data is probably, too much of an approximation. You need much more frequent data to get a more realistic idea of, of what your performance is going to be. But of course, in reality, I don't trade at the following day's close either. I trade at some point between the previous day's close and the following close. Usually, sometimes there's delays, but usually. So what I do is I then, when I come to actually execute my trade, and generally speaking, that's probably going to be roughly, kind of in the early hours of the morning for Asian markets, around 9-10 a.m. for European markets, and around 3-4 o'clock for US markets, very roughly. That sort of gives you a ballpark. When I come to actually execute my trade, what I do is as I'm coming into the market to execute, I take a snapshot of where the market currently is, so where the best bid is, where the best offer is, and of course the mid price, which for me is just a simple average of those two numbers. And then when I actually execute, and then that gives me another number. And then what I can basically do is actually disaggregate my slippage into different components, okay? So the first component is the difference between the previous day's close and the mid when I come to execute. So you can think of that as like a delay. And as I said, if you're trading slowly enough, that should be approximately zero. I mean, obviously, it'll sometimes be very big, because if the market's moved a lot from the previous day, then it'll be quite big, but it should average out to almost zero. And I check in my back test that it's almost zero, and I also check in my kind of live production environment that it's almost zero. So it's very, very noisy on individual trades, but it should average basically to zero. Because, as a slow trend follower, I'm not really suffering from the fact that I'm having to delay my execution by, a third or a half or, 3/4 of a day. And then what I do is I compare the mid price to where I actually execute, and that's my slippage. But actually, because I'm capturing the bid and ask, I can actually decompose that further into what, if you like, my expected slippage, which would be if I was to, trade either at the best bid if I'm selling, or vice versa, and versus what I actually receive. Now, if I was a big institutional trader, I would expect to do worse, consistently worse than that bid-ask spread, because I'm trading in probably much bigger size than the top of the order book. If I was just submitting market orders the whole time, and just which is the most naive thing you can do, I'd expect to always pay pretty much exactly half that spread. Because I'm actually using a little bit of a slightly fancier approach where I've got an execution algorithm, in practice, I actually make a little bit of money over and above. So I pay a little bit less than I would if I was crossing the spread every time. I can give you hard numbers. So I said I paid about 70 basis points in slippage. I'd be paying about 95 basis points if I just cross the spread every time. So my little execution algo has saved me 25 basis points, which, is not a lot, but 25 basis points every year, it's going to buy you
taking.
Even on my account size, it's going to buy a few dinners. It's going to be worth.
If we were having Andrew on the show today, he would say it's pure alpha.
It is. It is basically pure alpha, because it's also very consistent. So if I plot like the cumulative profits of that execution strategy, it's a straight line. It's like the account, the sort of dream account curve. It's got a bit of negative skew, because every now and then it does badly, because the market moves away from it very fast, too fast for it, and there's a bit of a sharp drawdown, but it's just a beautiful, otherwise just a really nice straight account curve. But so you can think of that as a kind of little high frequency overlay on my big, slow, ponderous trading system, to which I allocate effectively a tiny amount of my risk capital.
Cool. Good stuff. All right. Well, just staying in the trend following realm, not much really to report from this week. Obviously, we're recording on a Friday, so as of Thursday, yesterday, performance pretty quiet. Maybe a little bit up on the broader CTA indices that we follow, but not a lot of action. I think, though, since we are coming towards the end of a month, this is our last episode before the end of May. There has been some markets that have stood out, in my view. Japanese equities have done pretty well, I would imagine. Lean hogs, you mentioned yourself, also looking interesting on the short side. Orange juice, of course, a lot of people talking about that and that bullish trend that still continues. There's been a little bit of action in the base metals that also provided some opportunities, I think. And then, of course, yields have been rising again after the challenges of March. Yields have been starting to tick up again, although, of course, managers will have had to reduce their exposure, so the impact is less. Nevertheless, I think there are some nice performance to be picked up from those models who have stayed short, which, of course, is not all of them. My trend barometer stock at in the neutral zone as of yesterday was at 36, so it's just really been stuck in this neutral zone for months now, which I think reflects pretty well what's been going on in the CTA space this year. Up 1 month, down the next, and so on and so forth. We'll see when it breaks out, hopefully to the upside sometime soon. Speaking of the indices, I noticed that the Beta 50 index is up about 75 basis points, coming close to flat now for the year, down 1.55%. Same with the SocGen CTA index, up 1.5% roughly, down 1.75% for the year. Trend index having a good month, up about 2% for the month of May, down 2.6% for the year. One surprise maybe is the short-term traders index. It's down for the month of May, down 1.27%, and down for the year about 3.43%. So actually lagging now the other types of indices, despite a really hard-hitting March, and actually some quote-unquote episodes that shorter-term models at least is marketed to be able to navigate better than trend followers. Anyway, time will tell. MSCI World is down a little bit so far this month, down 1.4, but still up 7.5 for the year. And the government bonds, as I mentioned, yields are rising, so that index is down 1.6% in May. And the S&P 500 down about 0.5% so far this month, but still up 8% for the year. Now, as I said last week, just for those who think that the format is a little bit different today, well, it is because I'm trying to pack more content and less fluff into these conversations. So we're going to jump straight to the questions that came in from our great community. So thank you very much for all of those who took time to send a question to Rob. Anyway, the first one is from David. David writes, big fan here, reader, listener. I really appreciate the work you put out and the quality information for everyone to learn. Congrats, Rob, on the new book. Getting through it step by step. My question is about continuous trading signals construction. Suppose my discrete system will give a signal from plus to -1, and that my entry rules dictate to enter only when price surpasses the signal bar's high or low, depending on long or short. So there are no position to take until price sort of confirms itself on the next candle. Now, to make the signal continuous, what are our options? 1, make some sort of trailing moving average counting the signal bar in the last n bars, then introduce variations, multiple time frames, parameters, and then aggregate equal weight for the continuous signal regardless of where price is. Or 2, wait for the signal and wait for the price to move at the execution point and then modify the signal value from plus to -1 accordingly in order to consider the price movement in the signal. My intuition would tell me option 1 is less precise, but perhaps less at risk of overfitting. Any suggestions or references to particular sections of your books? Yeah, that's the first question.
I mean, the answer's neither, to be honest. Yeah, so if you were doing something like, say, a moving average system, then the basically you make your position proportional to, let's say it's just a single moving average system. So your signal is going to be whether the moving average is below or above the current price. And let's assume you're trend following because, this is Top Traders Unplugged. So you're going to wait for the price to cross over the whatever moving average you're using. And that would be the point at which you'd go long. And then the continuous part is you essentially make your position bigger as the gap between those two things increases. And the same is true if you're using double moving average. It's the distance between the two moving averages, and there's kind of vol normalization and scaling in there and stuff as well. Having said that, though, there is some kind of truth in option 1, which is that it's possible to construct a continuous system from a huge variety of discrete systems. And this is actually a statistical result, which basically says that if you combine a large number of random, uncorrelated binary things like plus and -1, you end up with a normal distribution. You end up with a continuous distribution of something. So the way of thinking about that is you can have a whole bunch of discrete things that say, well, if X happens, then buy or sell, which is the kind of definition of a discrete system. And then basically let's say you have 100 of these things. Well, you imagine you just assign them all a +1 for long, -1 for short, and then you add them all up, and you're going to get a number between -100 and +100, and that's basically then your continuous signal. So that's the other way of doing it. The language that Dave is using is kind of with things like candles and confirmation stuff like that is very much what I would call a kind of old school technical analysis sort of language, and it's all that's very much thinking about a discrete system as if X happens, then do Y. Continuous trading is completely different from that. Continuous trading says, what do I currently think the market's going to do? Is it going to go up or down? And I want to calibrate that thought and turn it into a number, and that could be done in a semi-discretionary way actually. But then once I've made that decision, I then translate that into a position I want to hold, and then I adjust my portfolio to achieve that position, which will, if I've got more bullish since I last checked, I'll be buying and vice versa.
Good stuff. I thought I had some audio problems just now because I thought I heard the word discretion when you just talked. But anyways, let's just skip that.
It must be. It must. We'll get the producer to edit it out because there's no way I would have said that.
All right. Okay. David has a little bit of a follow-up question where he says, how do we balance alpha signal and execution signal when converting a discrete system to a continuous one? Is there any thoughts on that from your side?
To be honest, I don't actually understand what he means by an alpha signal and an execution signal. Again, I think it's an old school technical analysis thing where, maybe you're using your Bollinger Bands to say whether long or short, but you don't enter your position until you see your Fibonacci thing confirm it, So it's more if X and Y do Z. Again, it's completely different from the way I trade, so I don't understand what he means.
No, and that's fair. I mean, I think that I'm sure everybody appreciates that when we get these questions, we obviously don't know always how what people mean when they send them in, but we can only read them as they come, and obviously we'll do our best. Here's another interesting one that I had to do a little bit of digging on. It's from Adrian. He says, do you believe in regime switching model for trend following strategies, such as the hidden Markov model to minimize variance on typical trend following strategies? Now, for those of you like myself that had no idea what a hidden Markov model is, I asked my friend ChatGPT, and just so you know, this is what it said. A hidden Markov model is a statistical model used to analyze systems with hidden states. It generates observable outputs based on these states, and the transitions between states follow the Markov property. Hidden Markov models are used for various fields and are helpful when dealing with sequential data and incomplete observations. Anyways, I'm hoping you kind of know what this is and can help Adrian.
I do. I actually know more about hidden Markov models than I do about the previous question, I'm pleased to say. It does feel like we've gone from the ridiculous to the sublime, I have to say. I think maybe next time, Niels, sort of space the questions out so we move more gradually from, candlesticks to hidden Markov processes. And actually, interestingly, the sort of technology inside ChatGPT does have sort of something a little bit like a Markov state model inside it, but, that's another subject. Basically, the way I think about this is that effectively, let's talk about markets. So markets are in regimes, right? So, and we can often identify regimes ex post. We can say, that's a bull market and a bear market, or here's a period when there's a lot of uncertainty, or here's a period when there was a recession, and so on and so forth. So maybe what we want to do is say ex post, well, look, here's a period when trend following does well, and here's a period when trend following does badly. If we can identify when those states are contemporaneously, in other words, if we know now this is not a good time to do trend following, or that it is a great time to do trend following, then we can kind of adjust our sort of position size or allocation to trend following if we're like an allocator, depending on what that signal is. And the key thing about these models is that we're able to identify sort of immediately when there's been a switch from one regime to another. Which isn't normally the case, because normally, let's say it's currently a good time to be trend following. No one puts up a big poster saying tomorrow the regime changes and it'll be a bad time to do trend following. Close your positions by the end of the day. Nobody does that. Sadly, it's normally a few months before you kind of go, well, actually, this is now a bad regime to be trend following. Before it was good. The idea behind these state models is they basically tell you the current probability that you're in a particular state. And you might have a rule that says something like, if there's more than an 80% chance that I'm in the bad state of a trend following, then I'm going to deallocate from my trend following portfolio. And hopefully that will allow me to make profits. So that's the theory. Now, does it work is the question. The answer is, not really. I mean, you can get great results with these sorts of models on a sort of purely in sample basis. So if you fit the model and you come up with your state transition probability matrix, as it's called, it all looks amazing, and you can see the thing switching beautifully in and out of regimes. But when you actually then try and run that out of sample or with real money, it's much harder. So Cliff Asness is a big fan of saying basically, don't try and time factor allocations. Just basically expose yourself to risk premia, like the risk premia from trend following, because if you're using any kind of model that sort of scales its bet size according to the opportunities available, in other words, you put on more risk when trend following has got more opportunities available, then that actually to an extent is kind of allocating and deallocating for you, and to then go beyond that and try and time it even more by using a Markov process or something else is really difficult. So there's that. Now there is potentially the other idea is to say, well, is there some other variable, some other thing we can use to tell us whether today is a good day or a bad day to be a trend follower? And the difference between this and the hidden Markov model is obviously this would be observable. You'd actually be able to have a number you can look at that would tell you what state you're in or what probability you're in a particular state. And again, this, it doesn't work very well. And in fact, the only success I've had with this is by using market volatility to tell me whether now is a good time or a bad time to trend follow. So trend following just doesn't seem to do so well when volatility is high, which is kind of a counterintuitive result. I'm not sure if I talked about it in the podcast before or not, but I think I have, so I'm not going to go into too much detail about it. But this is literally like the only thing I found in spending a long time looking at this, because people are always coming up with this bright idea. Wouldn't it be great if we could, do less trend following when it's bad and vice versa? In practice, it's very difficult, and I'd say, generally speaking, it's a bit of a time sink and a lot of effort to not really achieve much.
Yeah, no, I completely agree with that. And actually, I think it just goes back to the simple things that I think most trend followers would say if asked. And that is, you can't time it. Even us inside the industry, we can't time it. And actually, of course, we know often things happen, and which we'll talk a little bit about later on in the show today. Adverse price action might happen at a time when trends are actually pretty strong. And which just we got a reminder of in March, of course, because a lot of managers the day before the big event were at new all-time highs. Things were looking pretty good. So yeah, no, I think I completely agree with you. You shouldn't start adding more of these things, and I don't believe they work either. And if you need a tool to find out whether it's a good day or a bad day for trend following, just look at your P&L. So anyways, all right. Good stuff. We're going to move on to a question or two from Elie. Elie writes, I'm looking forward to Rob's return, and I have a few questions I was hoping you could share with him on the podcast. Of course. Rob says in his new book, and I should stress here, I'm quoting, of course, what Elie has written. Rob says in his new book that vol targeting is the second free lunch in finance, brackets, there goes Jerry falling off his treadmill, bracket end, full stop. This applies to trading systems such as trend following, but it also applies to a buy and hold portfolio, as Rob discusses in the first few chapters of his book. My question is, many traders have extremely limited capital and cannot hold a basket of vol-targeted futures. The best they can do is to own various stocks, bond, and commodity ETFs, which trade for several $100s a share. Assuming they can't take on leverage, is there value in relative vol targeting? To take a simple example, suppose you want 50% of your risk in stocks and 50% in bonds. You would adjust your positions daily so that you maintain those percentages, but the overall vol of each position and the portfolio could be fluctuating quite a bit. Is there a lunch to be had? Not
sure there's a lunch. There's probably a light snack. Okay, there's a big issue. There's a big elephant in the room, but I'll come to that after I've answered the question, if that's okay. So, ignoring the elephant, holding a sort of relative vol-targeted portfolio of stocks and bonds would be better than not doing it. If you think that vol-targeting has value, then this kind of relative vol-targeting will also add value, although not as much as if you could trade, leverage futures, which, is the issue, right? But this is a kind of very, very minor problem, because there's a much, much bigger problem, which is this. If you want to hold equally risk-weighted portfolio of stocks and bonds, you're going to have a much bigger proportion of your cash in bonds than in stocks. It's going to be like, you're going to have like a 20-80 portfolio, something like that. Maybe not so much recently because the vol of bonds has gone up quite a bit recently. But on a historical average over a long period of time, you're going to have more of your capital, your cash, in bonds to achieve what you want to achieve, which is a equal risk weighting across both assets. And that portfolio will give you the maximum risk-adjusted return, will give you the maximum Sharpe ratio. But of course, what it won't do is give you much of an absolute return because you're getting rid of a lot of return from stocks and exchanging it for low volatility. And because you haven't got the power of leverage, you can't then convert that Sharpe ratio, that high risk-adjusted return, into a high return at a given risk target. So you're going to end up with a portfolio that has a sort of expected standard deviation. It's going to be halfway between stocks and bonds, so it's going to be maybe like 10, 11, 12%, something like that, depending on what your bond portfolio's got in it. And it's going to have a return that's okay, but is nowhere near as good as expected return would be if you were in a much higher percentage of stocks. And this is the problem of the efficient frontier that finance has known about since the 1950s. So I'm not telling anybody anything here they don't know. And that's the main issue you're going to have, and whether the fact that your expected volatility is going to vary day by day in this risk-weighted portfolio. It's a very, very minor issue indeed compared to the problem you have in that your actual return is going to be quite a bit lower, and there's no way of easily squaring this circle. If you can't use leverage, you often have a straightforward trade-off between, and you have to accept either a lower return to maximize your risk-adjusted return, or you accept a lower risk-adjusted return to maximize your return, or you could maximize, your CAGR, your geometric return, which is going to put you somewhere between those two, and that's theoretically the best thing to do. And that's going to result in probably a much higher proportion of your money in stocks than you would, and therefore a lower risk-adjusted return. But you can't eat Sharpe ratio is something I'm fond of saying, unless you can use leverage.
Right. You talked about an elephant. Did you talk about the elephant?
I did talk about an elephant, yeah. That is the elephant.
Oh, that is the elephant. Okay,
yeah, there isn't another elephant. There's not two elephants in this room.
There's not two elephants in the room.
No, how big do you think this room is?
Yeah,
it's not that big.
I don't know. I'm looking at your shed, and it's pretty big, actually. So.
It's not got room for two elephants. Only one elephant. Only one.
All right. So there's a follow-up from Elie, and he writes, Rob calculates different trend signals, and assuming they're all of the same type, like exponential weighted moving average, he equal weights them. This is effectively rebalancing between signals every day. Has Rob considered maintaining each signal's allocation for a longer period and then rebalancing periodically through rebalancing bands or some other methodology? This would presumably lend to some more positive skew to the portfolio. Is the potential benefit not worth the substantial extra work, or is this suggested method not in fact optimal? I know these were long, so thank you in advance for taking the time. There we are.
Yeah, it's actually a very interesting question. I kind of like the question because it's forcing me to think in a way I don't normally think, which I think is good, right? I mean, the first question was doing the same thing, but in a way I didn't like as much. This is a much more very intellectually stimulating question. So I'm just waffling here to give myself time to think, Niels, clearly.
I know.
You know that.
Time.
The listeners know that. Sure. It's a familiar strategy that I use. Because basically this question only makes sense if you imagine that each of your little kind of trading rules is effectively like a mini portfolio. And, the Eli's correct. What I'm implicitly doing is in the same way we're allocated to stocks and bonds just now, I'm allocating money to each of these little mini portfolios, and implicitly I'm giving them the same amount of risk capital every day. And that's kind of what's happening. So the alternative way of doing that is to sort of say, well, if a little mini portfolio is doing well, then that's going to end up getting more money in the same way that if you had a stock and bond allocation, you weren't rebalancing, so you start with say 60-40 and then stocks do really well. At some point you'll be at, 80-20 and you kind of, without rebalancing, that's where we'd eventually end up. That is better If you have trends, obviously, because you want to kind of let the trend ride in your stock portfolio, and it depends on your rebalancing frequency. So, if you rebalance, say, once every couple of years, that's pretty good, because that's when the trends are kind of exhausted themselves. And Cam Harvey, of course, is a great friend of the show, has written some stuff on timing rebalancing in relation to momentum effects. So it's quite an interesting topic. So that's with the underlying assets. Now, what about in this case where we've got these little portfolios consisting of trading rules? The question is whether does the trading rule P&L itself have momentum? And the answer is, well, it's not really. There's not really much there. It's not a particularly strong effect. So, broadly speaking, the P&L from a kind of medium speed momentum sort of fund, if you like, does seem to have some, what we can get technical, positive autocorrelation for frequencies between about 6 months and a year. So if trend following's been, we go back to the earlier thing about Markov states. Another way of thinking about it is like this. Well, if trend following's been doing well in the last few months, it's probably going to continue doing well in the next few months, because this is positive autocorrelation. If you like, momentum has momentum. But it's not a very strong effect. It's a very weak effect. It's not really statistically significant. So it kind of comes down to being one of these things that's kind of, for me, intellectually curious. But as the questioner says, the amount of work involved in exploiting this would be just enormous compared to the potential benefit. And it's not just the work, it's the fact that you make your system more complicated, your code becomes more potentially buggy, you lose intuition. It's just a whole heap of reasons why you don't want to introduce complexity into your system unless you think there's a really, really strong benefit from it. Now, the reason I said this question made me think is because I don't actually in practice run lots of little mini portfolios of trading rules. That's not the way. Essentially, when I'm at the stage of having lots of trading rules, different, say, moving averages of different speeds, and I'm combining them, at that stage, they're just numbers. They're not kind of quote unquote portfolios. I haven't translated them into positions. Because that's why I said the question made me think differently, because the way I construct my portfolio means this question never comes up. So yeah, it's an interesting question, and it made me think, but I think the answer is probably no for me.
Okay, cool. Something else that might make you think, Rob, actually, is Alan and I had a pretty interesting conversation with Brian Proctor that we published on Monday. He was very open about some of the stuff they were doing, which were certainly different to how they were taught, because he and actually the founder of EMC were both turtles. And I thought it was quite interesting. Anyways, I'm not going to spoil the information here. People should go and listen to that episode. All right, last question is from QuantLurk. Even though we prefer people use their real name, frankly, when they ask a question.
This came on Twitter, though, so what can you do?
I know.
Most people don't use their real names on Twitter. You and I are exceptions.
But in a DM, people could still say,
this is so-and-so.
All right, QuantLurk writes, what kind of extensions/strategies to your overall approach would you be looking at if you had more resources? That is not managing all of your systems by yourself, having more money to spend on data, being able to trade on higher frequencies and the like. I'm not going to send it per email, but you might want to address it. All right, well, we will do that, QuantLurk.
I guess so. My kind of go-to for making my system better is diversifying across instruments, and that's what I just said to you. I was doing at the start. I'm a big fan of that. So I guess my kind of futures portfolio now is pretty much maximally diversified. As I said, I've got over 200 instruments. There's a few instruments I don't trade because of data fees. Orange Juice actually is one you mentioned. Also, actually, ironically, I can't trade any of the futures that trade in the UK on the ICE market. So that's, the FTSE 100, the gilt, the short sterling. I don't trade any of those. And also, they also have some interesting energy contracts like Brent. I don't trade any of those. So I guess I'd probably add those. That would be, given I've got all this extra money that I've been given. And then also, obviously, in terms of instruments I don't trade, so beyond futures, you've got single stocks. That's quite a lot. That would be quite a lot of work to implement and to set up a team to do that. So I'd probably do that. I'd probably trade options and futures. Well, if I think about the kind of classic kind of canon of things that CTAs have tended to expand to beyond futures, the other one is FX forwards. That may be not such a priority, but there's quite a few exchange rates you can't trade with futures, at least not that they're liquid. So there's potentially a bit of value there. And then you've got OTC instruments like interest rate swaps and things. Back in the day, it was all kinds of random stuff I was trading. So that would be my first kind of go-to thing. The next question then I guess comes, would I change? I then look probably at my, I think my trading rules, if you like. So that, so if you think about, if we're diversified across instruments maximally, next thing is to think about diversifying versus rules and style and things like this. So my kind of to-do research list is always like longer than anything I could achieve in a lifetime working by myself, even if I spent all my time on research, which I don't. I'd be able to give my research team a huge long list of things to look at. So, for example, I think I'm allowed one plug of my new book per episode. In my new book, there's quite a few strategies which actually I've researched, but I haven't implemented in my own system due to lack of time and resources. So, there's some stuff there that I know will work. And then, the QuantLurk talks about the next kind of angle of diversification, which is frequency. I think there's probably some value in, I described to you, I have a simple execution algorithm that, earns me this 20 basis points of free alpha. I think obviously if I was running a bigger fund with more capital, I'd have to focus more on execution and doing that well. And in the process, that would mean also that there's potentially faster trading strategies I could look at, which would require smarter and fancier execution. But yeah, high frequency, I mean, it's not my area of expertise, and I'm a big believer in sticking to your area of expertise. But I guess the main benefit for me personally of having this huge team of people is I could be even lazier than I currently am and just literally delegate everything. So I'm looking forward to presumably QuantLurk's gonna allocate some money to me, so I'm looking forward to seeing that.
Exactly. Now, you say this thing about kind of in gist that if I had a bigger team, but you know what? Just from conversations that I've had, and not that I'm a specialist whatsoever, but I have to say, with the speed of what AI is doing, who knows how many real people you need to have to do research. Maybe there is actually in a couple of years available technologies that might do a lot of that work. But that's a different discussion. Just want to throw it in there. All right, we're going to tackle a couple of topics that you sent over, and then maybe if we have time, just one research paper that came out also since we last spoke. Now, you sent me essentially 3. I think 2 of them are more sort of in our wheelhouse. The other one is a little bit macro oriented. And I actually want to start with the one where you say, which CTA should I buy or should you buy? Because I was quite intrigued by the title, because you gave me no clue what this is going to be about. So I'm just going to have to give you the mic and listen.
Yeah, so I have to admit that this was inspired by, I was listening to another podcast. I'm afraid to say, although I think you've probably covered this in at some point, the cockroach portfolio.
Yeah. No, I mean, Jason has been on the podcast. Yeah, sure.
So I remember. I think I obviously heard the episode quite a while ago, and you had Jason on, but he was on another podcast more recently. So that's where, and I was kind of reminded of it. But we don't go into details about what the cockroach portfolio is. You can go back and listen to the previous episode. It's an interesting idea, but the important thing for this conversation is part of it has an allocation to CTAs, and the allocation is there was some discussion around what the CTA allocation's for. Okay, and I found this interesting because actually thinking about what the CTA allocation is for then implies what kind of CTA should you actually be allocating to. So this is very much a section for allocators, because I think, generally speaking, as sort of CTA managers, if you like, as people who trade CTA strategies, we tend to kind of, I think, to an extent, craft the CTA versus our belief in what, a good CTA looks like. So, for example, we have these debates over things like, should we trade faster or slower? Okay. Should how kind of sort of positive skewy should your CTA be? Should you kind of be all out for positive skew, which implies things like, for example, you shouldn't vol target, and so on and so forth, or should you be focused more on getting a sort of more balanced proportion of money coming in? Things we don't maybe talk about so much, but related to this are questions like, what should the beta of your CTA be? So what's your average exposure to the market, whether the market is 60-40 or just S&P or a long only basket of the things that you're trading. The other thing that we probably, again, don't talk about so much, but if you look at the industry, there are managers who have a tilt towards a particular asset class. So there are managers who, for example, just trade commodities. There are other managers, although this isn't as popular, who only trade financials. The sort of, obviously there is a lot of people have the same portfolio that I do, and I think yourself, where you're kind of trying to get a reasonably balanced allocation to all the different asset classes. But some people are very much the view that you should trade one sector or another sector, or have a tilt towards different sectors. So these kinds of decisions, in terms of crafting your CTA, the manager makes them on the basis of their own opinions and ideology, if you like, but also their perception of what they think clients want. But actually, I was listening to this stuff about the cockroach portfolio. Actually, what this really comes down to me, what the client really wants, if they think the client thinks about it, they may not think about it in such a particular way, structured way. What they really want should matter depending on what the rest of their portfolio looks like and the reason why they're buying the CTA. Let's, for example, take some examples. Okay, so let's suppose that the reason you're buying the CTA is to provide you with a kind of positive convexity, sort of downside protection in the event of a stock market crash. So that would imply, firstly, you're probably going to want a huge amount of positive skew. Okay, you're going to be wanting all of that. You want to be on something that's looking a lot like kind of tail protection. The kind of the sort of disaster protection kind of CTA. You're going to be wanting designing something that's very much like that, and you're probably going to want a bias towards financials. Okay, and the other thing you're probably going to want is either a zero beta or potentially even a bias towards a negative beta, because you basically want something that's going to kind of trickle along, and then if the stock market crashes, is going to make a lot of money and protect you from all the bad things that are happening in the rest of your portfolio, for example. But let's suppose that the reason why you're buying your CTA is for inflation protection. And I think this is in the context of the cockroach portfolio. It's a replacement for gold, which was kind of the sort of, this is the inflation proofing thing that was in the the original kind of the Harry Brown portfolio, and it's a better gold, if you like, because it has the positive convexity that comes from trend following, but also because it's actually trading the things that cause inflation. So what's caused inflation in the last 2 years? Energy prices, food prices, and the two are linked, of course. So that would imply, okay, well, what does that imply for the CTA you're allocating to? Well, you probably want to have something that has got a bias towards being in commodities. You're probably potentially going to want to have a long bias, a long bias in terms of beta in those commodities as well. And you're maybe not so bothered about the financial side because it's less clear what happens to stocks, certainly in inflation environments. Bonds will probably go down. So yeah, maybe you want some bonds in there, but again, you probably want to have a negative beta in there on average as well. And sorry, I should have said as well, the other thing to say, if you want something that's got more positive skew, so in the first case, you're probably going to want faster trend following rather than slower trend following, because that's going to have a higher positive skew as well. So that's kind of, there you go. I've laid out my kind of concept for you and explained it, and I'd love to discuss it some more.
Yeah, no, I mean, I actually have heard this as well. And, on the surface, it kind of makes sense, but I actually disagree. Because a few years ago, I heard this argument from the short-term space, not everyone, but from some short-term managers saying, well, markets are moving so fast. We're really the only strategies. This came after the 2018 Volmageddon, where clearly short-term managers did better. So the whole thing was, well, we're the only ones who can really move fast enough, and we will give you that convexity and all of those things. But since then, short-term has done nothing, not even through some of these crises, not even through March. As I just said it at the top of this episode, they're trailing this year. This year is one of those years where we've had two kind of reversals. They should have been all over that, but they're not. So it's not that I have anything against short term. It's just it goes back to the whole, in my opinion, why you want trend following. And that is because we don't know what's going to happen and how markets are going to react. So even if you're telling me, oh, we're going to have 8% inflation, so you should have this kind of strategy, we have no idea if that kind of strategy will deliver in an 8% inflation environment, so to speak. And so this is why I think you should definitely diversify your portfolio. You should have different type of strategies, but I'm very cautious about having these steadfast explanation as to how a strategy will react in the future. I really don't think we know. We can say we know that.
So I guess the implication of what you're saying for the short-term managers is that the sort of use of a CTA component as a kind of like a poor man's tail protection, if you like, is a bit, is not really what CTAs are for. I guess
well, I think that is to some extent true, and also think that, I mean, you could say short term is within the CTA definition for sure. I don't view short term strategies as short term trend following. I think they do something different. They explore or exploit the expansion of momentum, etc., etc. But that doesn't mean they're waiting for the prices to turn against them before they get out and all that stuff. So I just think it's a dangerous game to try and say, well, we know this strategy will do well. It's almost like the debate that was a little bit between Bitcoin and gold a little while back, where people were saying, well, if this happens, then definitely gold is going to do much better, or Bitcoin's and it just didn't. And people were saying, well, when inflation comes back, gold will do tremendously well. It didn't really do a lot when inflation was at its peak. It's done better recently as inflation has calmed down a bit, but. So I'm just cautious about these very.
So I think there's a difference between what I'd call an empirical judgment about what makes a good inflation hedge, which is where you basically look at history and you say, well, in the 1970s there's inflation and gold did very well, therefore gold is a good inflation hedge. I mean, I'm a big downer on those things because, first of all, there aren't normally, or it's been a long time since we've had inflation, right? So that means you can't do that with Bitcoin because it just wasn't around in the 1970s. Secondly, that these inflation episodes are, and then there's not that many of them, I think it's unreasonable, therefore, to draw a conclusion. And thirdly, things change. So the pressures that maybe drove gold higher in the 1970s with high inflation don't necessarily apply now. So that's one thing. But I think there's a difference in that and a kind of thing that structurally will do well. So. If you want to, the two out here is buying an inflation hedge, right? So obviously the purest inflation hedge is TIPS in the US, or the linkers in the UK, and I can't remember what the French and the German equivalents are called, but they're very expensive, right? They cost you a lot of money. So you want to buy, so in the same way that a pure tail protection strategy is expensive, right? Because you're buying all this out of the money, these money options, and it will definitely pay out if the market moves against you. It will definitely pay out, but it will be expensive. So what you're doing is you're saying, well, I'm going to exchange some certainty for some price, right?
Well, if the market moves against you in a certain way, which long vol managers realized last year.
Yeah, and there's been this interesting discussion about that, which I found very interesting actually, and the work done. I think it was by AQR, showing that actually these things, don't always pay off when you expect them to, because you can't. It's to do with roles and timing and stuff like that. But anyway, so the thing about the idea is to say, well, I think you might say, well, if I'm worried about inflation, I think inflation is going to be driven by energy and food prices, then I basically want to be long commodity futures. However, being long commodity futures is expensive because they normally have a negative roll yield. And that's true whether you buy them directly or whether you buy them via an ETP or an ETF. So what I'm going to do is basically trade certainty for value and say, well, a cheaper way of doing this is by trend following commodity futures. And therefore, when they do spike, so when they do spike, I'm going to participate in that upside. I'm hopefully not going to lose out as much on average with the roll yield the rest of the time, particularly because, if you're trend following the adjusted price, if the spot price isn't moving, you will have a short position. You'll just be collecting that roll yield the whole time. It's an interesting idea. Now, I don't personally do it, but I can understand the argument for saying things like, well, okay, in isolation, you don't want to have any kind of sort of beta biases within a trend following portfolio if that's the only thing you own. But on the other hand, if you own it alongside 60/40, well, maybe it makes sense to either reduce your allocation to bonds and stocks in your trend following portfolio, or alternatively, or as well, change the kind of beta bias so that you're less likely to be long those two assets because you've already got a whole bunch of long exposure coming in from elsewhere. So, I think I think it's true to say generally that the trend following portfolio you'd put together in isolation would be different from the one you put together if you considered sort of the rest of a portfolio that an investor's holding.
You mentioned something earlier in your when describing this. You said, well, if people are worried about the equities, maybe they want to be more financially oriented in the manager. I think that's completely false. I think it should be the opposite. It's almost the opposite because if you go back and you look at the data, what you find is that when equities suddenly are doing badly, like in a quote-unquote crisis period, the part of the portfolio that tends to deliver the returns are actually the commodities, because we're going to be caught on the wrong side of the equities. We may even be caught on the wrong side of the bonds as well because of the correlation between the two. So this is why. I'm not saying this is going to happen all the time. This is just why. One example, very simple example, as to why I don't want to advocate for these kind of certainties in terms of how strategies are going to behave specifically, because we don't know. That's the whole point about trend following. I want to go back to that. The other thing I want to say, since that I'm thinking about here, is it's almost like people saying, well, if interest rates go up, stocks must go down. But that's not true either. There are, examples of where you have periods where interest rates go up and stocks go up for several years, vice versa. In fact, you have all combinations of up and down between stocks and bonds. They exist, and they're not just for short-term periods. They are for multi-year periods. So my point is that the reason why I'm so committed to trend following is the fact that, you need to know what you don't know. And we don't know what the future looked like. Even if we have history to rely on, our systems may react differently, or meaning markets may react differently, and therefore we will react differently in the future. So I understand that from a narrative, it's a great narrative, but I think that's where I would leave it. Now, the portfolio as a whole, having, a combination of different types of assets and all of that stuff, of course, that makes total sense. But to take it that far and say, well, if you want this, you have to buy this kind of CTA. If you're that, then you have to buy this CTA. No, I think you should have a diversified portfolio of CTAs that are structurally different. If you want to diversify your CTA portfolio, find some managers that are structurally different. But don't say that you know exactly how they are going to perform given a certain event. I think no, none of us will know that. Anyways. Now, we don't have much time left. I don't know if you want to keep this to another time. You talked a little bit about that. And actually, I would just suggest people go to your blog and read the latest post you've done about changing some of your trading rules and so on and so forth, adding more markets, etc. I think that's definitely worth a good read. You brought up the thing that I mentioned in the beginning where you said this is a little bit macro-oriented. That's the debt ceiling. Of course, I'm always intrigued when you bring something like that up where I'm thinking, what on earth has that to do with trend following? But we like talking about macro. So, well, what are your thoughts, my friend?
It was something interesting. So, as I've said before, that the whole debt ceiling thing is just ridiculous. The fact that the debt ceiling exists the way that a certain political party in the US uses it as a kind of political weapon is just completely insane. From the world's largest and most economically successful country and on most metrics to behave like this is just bonkers. But anyway, I said that before. No, it was more a kind of interesting kind of game theory type take on it, which is I read somewhere that someone said, well, the thing about the negotiations is actually the Treasury is kind of screwed up here, because they could have had like plan B, C, D, and E ready, right? So obviously there's been all kinds of ways discussed as to the ways that you can kind of technically get around this debt ceiling thing, and some of them are just a bit silly, but others are kind of more serious. But they would all require some changes to the kind of operational procedures of the Treasury when issuing debt. And the point that was being made was, well, they haven't done any of this stuff, Whereas if they'd done it, if they'd actually said, well, yeah, we actually do have Plan B, which is we're going to do this. Plan C is where we're going to do this. Plan D is where we're going to do this. We've done the work. It's literally going to be a question of pushing a button on a computer somewhere. Then that would massively have strengthened, Biden's negotiating hand in terms of getting this resolved, because it would be like, well, okay. At the end of the day, there may well be some constitutional challenges and it'll go to the Supreme Court and what have you, but that will all take time. And in the meantime, they'll be able to borrow more money and it'll all be fine. And the kind of massive potential economic damage and market uncertainty and all this stuff would be completely avoided. I think it's quite interesting, because normally when you think about things like financial plumbing and this kind of stuff, often people are trying to correct for mistakes that have happened before, right? So the bad thing happens. Let's go back to 2008. The way that CDS were traded OTC and not centrally cleared was a bad thing and led to a huge mess. For example, when Lehman's went down, and so they're like, oh man, we should do something about this. We'll move to central clearing, and now everything is a lot safer. But the point is that they didn't do that until the bad thing had happened. The debt ceiling is completely different. This is a bad thing we've known about for decades. And therefore, I just find it astonishing that the work wasn't done, in advance to kind of sort this out. It's almost like they're waiting for the debt ceiling to hit the limit and for, all this chaos to be unleashed before actually saying, oh, well, there's something we can do about this. But it's not like the CDS thing. It's not completely. It's just something that you didn't see coming. We knew this was coming.
Well, I mean, I obviously agree with you here, Rob. But funnily enough, I think in politics, sometimes you may want to provoke a disaster, because what happens in the aftermath is you're given powers that you would otherwise not be given. So, I mean, I'm not suggesting, of course, that that's what the plan is. I'm just saying...
So whose plan is this? Is this the Republican or the Democrats' plan?
Oh, I have no idea. I don't want to get into US politics anyways. And funnily enough, I mean, obviously, from the latest news, when I looked at the Bloomberg website, of course, they say that things are moving closer to an agreement. But the interesting thing is that even if they do agree, there's a lot of Democrats that are not happy because they were negotiated directly from the White House, which is so. Anyways, unfortunately, I don't think we're going to have time to go into the white paper, or not the white paper, the research paper from Quantica that I wanted to talk about. We'll do that another time. And then actually, I'm going to wrap up by saying that next week, I think people really want to tune in as well, because I'm trying to tee up Andrew for a debate with a CTA that is not particularly seeing eye to eye on what Andrew is doing with his product. So I'm hoping it's going to be quite a fun and lively debate. So watch this space. Hopefully it'll succeed. Of course, anyone should go out and get Rob's book now that it's available. So make sure you do that. And of course, if you have any questions for this debate coming up, pros and cons about the CTA replication products that's out there, send them to info@toptradersunplugged.com, and I'll try and squeeze them into next week's conversation. From Rob and me, thanks ever so much for listening. We look forward to being back with you next week. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.